Hello everyone, you're watching the official Pocket Option channel. Today we're going to talk about something that might seem very simple at first glance, but in reality it holds tremendous power. I'm referring to those special moments on the chart when just one candlestick can provide us with so much market information that it sometimes feels like we've discovered a secret map of future price movements. Sounds incredible, doesn't it? Well, how can a single candlestick give us more insight than entire complex patterns or advanced technical indicators? But trust me, if you know what to look for and how to observe it, candlestick analysis can be extremely effective. In this video, I want to share with you how I personally use candlestick patterns, how I interpret them, and why sometimes it's better to focus on the simplest element on the chart, a single candle, to make trading decisions. By the way, if you want to see more videos of real trades where I apply those concepts in practice, you'll find plenty on the Pocket Option channel, featuring trading in real market conditions. However, I always emphasize that historical analysis, looking at past price movements, is one of the most effective ways to learn. Without understanding what has really happened, we can properly forecast what might happen next. So let's get started. A single long-bodied candlestick can be the key to understanding price movement. What does that mean? It's a candle whose body is noticeably larger than those of the neighboring candles on the chart. So this matters because sometimes you might see an entire chart filled with big candles. So one big candle won't stand out. But if the chart mostly has small candles, then suddenly one large, powerful candle appears. That's a big signal. Now imagine we have a long red candle during a downtrend. Compare its body to the other candles. It's significantly bigger. That alone should catch your eye because size often indicates stronger momentum, whether from sellers if the candle is red or buyers if it's green. Here's what I usually pay attention to: the candle's midpoint. If you draw a horizontal line at 50% of that candle's body, it often becomes an important resistance level. If it's a bearish candle, or support level, if it's a bullish candle. The start of the candle, meaning the price at which the candle opened for a red candle, or the closing price if we're talking about a green candle, this level can be the second edge of a zone. Thus, we can highlight a resistance or support zone by drawing a line through the candle's midpoint and at the candle's opening of a red candle or closing for a green one. If we then scroll the chart forward or backward, you'll often see that the price reacts to or near the zone. When the price returns to this level in the future, there is a high probability it will bounce or at least pause, because the body of that large candle has left an important footprint of strong selling or buying activity. Let's say you spot a long red candle that does form such a zone. If you decide to open a short position, you can set a stop loss just above the start, which is the open, of that red candle. Because if the price goes above that mark, it means the market has recovered from the bearish momentum indicated by the large candle and may shift to a bullish move. Of course, no pattern or signal is 100% guaranteed, but sound risk management and placing a stop loss at logical point is the key to successful trading. There's another interesting point regarding these long candles. We often see a major candle break through a trend line, whether it's a downtrend line for a bullish breakout or an uptrend line for a bearish one. This may signal that something important has changed in the market. It's as if the market is telling us the previous trend was losing strength and now new participants, which we call buyers or sellers, have stepped in to push the price in the opposite direction. Now, imagine you have clearly drawn downward trend line and suddenly a long green candle not only breaks that line, but also surpasses a horizontal resistance level. That's an extremely strong indication that buyers are taking control at that moment. Usually after such a breakout, the price keeps rising because the large candle signals strong momentum. But remember, after every strong move, the market often corrects or pulls back. Price can move continuously in one direction without taking a breather, so keep an eye out for a potential pullback after this breakout, of course, candle. One of the reasons I love candlestick analysis so much is that these levels can remain relevant for a very long time. I've seen instances where the start of a long-bodied candle created a resistance or a support zone that the price returned 2 years later. It's really impressive, but if you think about it, it makes sense. A sharp spike or drop in the past indicates strong market sentiment. So when the price returns to that zone, some of the players or new ones looking at the same chart remember that previous strong move and react in a similar way. That's why I always say, never underestimate the power of just one candle. Used correctly in the right situation, a single candle can help us determine the potential for a short or long position, place logical stop losses, and spot a significant breakout of trend lines or key horizontal levels. Now let's move on to the second type of candle. What are candle spinning tops? A spinning top is characterized by a relatively small body. The open and close are close to each other and longer wicks on both top and bottom. This shape indicates indecision in the market. Neither buyers or sellers have full control, and the candle ends up closing roughly where it opened. Although there was some back and forth within the candle, when should you pay attention to spinning tops, you might ask? They appear quite often, so not every one of them is a strong signal. However, if you see a sharp price move, a clearly defined uptrend or downtrend, and then at the end of that move, a spinning top appears, I start to think, okay, it looks like the market has paused, right? Maybe we're seeing the first signs of a reversal, or at least a consolidation. Still, a single spinning top by itself isn't always a strong reversal signal. It could just indicate a short-term pause before the price continues in the same direction. Alternatively, it might lead to sideways movement, a consolidation where the market trades in a range for a while before deciding where to go next. The next important candle is the doji. The doji is similar to a spinning top, but here the open and close are almost exactly the same, so the candle's body looks like a thin line or a plus sign. A doji also often appears after a strong trend, signaling that the previous momentum may be weakening. Buyers and sellers are both waiting to see who will take the upper hand next. When a doji appears at the final stage of an uptrend, after a significant bullish move, it increases the likelihood of a reversal because it suggests that buyers may be running out of steam. Conversely, if doji shows up on the bottom of a prolonged downtrend, it's a sign that sellers may be losing strength, giving buyers a chance to push the price upward. However, it's usually better to wait for confirmation. That means looking at the next candle to see whether a reversal is really happening. It might happen that the next candle closes well below the doji's low in an uptrend scenario, confirming that sellers have taken over. Or if we're talking about a downtrend, the new candle might close above the doji's high, indicating that buyers have suddenly stepped in strongly. Sometimes you see several spinning tops or dojis in a row forming a small zone of indecision. For instance, you might see these dojis in a row after a long uptrend. That's a strong signal that the bullish momentum is fading and that a consolidation or even a full-fledged reversal could be around the corner. If you want to open a short position at the site of 3 dojis at the top of a major uptrend, you could wait for a strong red candle to confirm that sellers are stepping in. Then you place your stop loss slightly above the highest point of that doji cluster, because if the price does go above that cluster, it means the uptrend isn't finished. The risk management approach limits your losses if the market moves against you. The same logic applies if such indecision candles appear at the end of a big downtrend and you want to buy. Wait for a solid green candle, set your stop loss below the doji's low. If the next candle goes even lower than that low, it means your bullish reversal idea wasn't correct and it's better to cut your losses promptly. All these concepts, long-bodied candles, spinning tops, dojis, become far more powerful if you do serious historical analysis. Look at past charts, find places where the price reacts to a single large candle and observe how it behaved around that candle's midpoint or starting point. Check out how spinning tops and dojis appeared at the peaks or troughs of trends. See whether they led to reversals or merely signaled a temporary pause. Studying historical patterns hones your intuition. When trading live, you'll start to recognize, oh, this setup looks like that situation I saw 2 years ago on the same currency pair. Or it seems this big red candle might form a new resistance zone, just like before. Over time, you'll make quicker and more confident decisions because your memory of examples is growing. As for practical application, it's quite straightforward. First, mark your zones quickly. Once you notice a standout long-bodied candle, draw 2 lines, one at the candle's midpoint and one at the opening price. Shade the area to use it as a potential zone and keep it on your chart for future analysis. Second, observe how price reacts. Pay attention to what happens when the market returns to that zone. Does it bounce off that midpoint? Does it break through and turn the candle start into support? Keeping an eye on these details can lead to great trading opportunities. Third, wait for a confirmation on indecision candles, whether it's a spinning top or a doji. Remember, that by itself, it only signals uncertainty. The real signal often comes on the following candle, especially if it's a strong and indicates a reversal or a continuation. Fourth, manage risk with logical stop-loss orders. In candlestick analysis, the candle structure, its high, low, open, and close plays a big role. Place your stop-loss where a break of these boundaries would invalidate your idea. Never neglect historical analysis. Look at different timeframes, scroll through charts, and see how certain candles formed key levels. Over time, this lets you detect similar setups faster when trading live. Let's take an example. Say you open a chart and see a strong long-bodied green candle that appears after a series of small indecisive candles. You immediately mark the midpoint and the start of the green candle. Suppose that the next time price pulls back to this zone, it bounces almost perfectly from the candle's midpoint before heading back up. That's the kind of reaction we look for. We could have opened a buy trade with a stop loss below the candle start, giving you a nice risk to reward ratio. Or imagine you see a big red candle that breaks a trend line to the downside, confirming a downtrend, of course. The next day, price recovers a bit but can't go above the open of the red candle. That's a good sign for entering a short position as the market continues to respect the momentum indicated by the large bearish candle. You set your stop loss above its open, and if the price never goes higher, you stay in the trade, looking for further downside. As you can see, one single candle can give us a wealth of information. It can point to a new resistance or support zone, hints at a possible trend reversal, or confirm a trend line breakout. That's why I'm such a strong advocate of in-depth candlestick analysis. Once you understand how powerful and detailed these signals are, you'll start to see your charts in a new light, realizing that they can contain an almost complete script for price movement. It might not seem like much at first, but if you apply these principles every day, even in small doses, you'll notice how much your understanding of price action grows. And of course, remember to combine this knowledge with proper risk management. Placing stop losses wisely, managing trade amounts, and so on. All of this together leads to consistent results in trading. If you enjoyed this video, please give it a like and subscribe to the channel if you're new here. Hit the notification bell so you don't miss any new releases. Also, I invite you to join our official Pocket Option Telegram channel where we share signals, market insights, and strategies. You'll find the link in the video description. Thank you so much for watching. Your support and comments means a lot to me. I do my best to post helpful content regularly so that you can continue growing as a trader. My personal philosophy is that small but consistent steps in learning will lead to significant improvements over time. All right, friends, that's it for now. I hope this information helps you in your trading. Let me know in the comments how candlestick analysis has helped you or what else you'd like to see in the future videos. I wish everyone the best of luck and, of course, profitable trades. Take care, and I'll see you in the next video.